Good afternoon, everyone. Thanks for joining us for Big Plans for Small Businesses. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion is not sufficient for the CE credit. Continued education credits are being offered for the following designations: CFP, CIMA, CPWA, CIMC, RMA, CPE, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we would like to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. Let's get started. Our instructor today is Mary Reed, Pentegra's National Director of Pension and Protection Planning. Mary is a specialist in qualified tax advantage strategies for small business owners. She helps those business owners turn a good year into a great year by keeping more of what they have earned. Mary, I'll turn this over to you to start talking big plans for small businesses.
All right, thank you very much and welcome everyone. All right, so today what we're going to talk about, when we talk about big plans for small businesses, we're really going to focus a lot on the 401k arena today. We do all kinds of plans for all kinds of businesses, but today specifically, a lot of this will be geared towards 401k. But you know, plans can have any; those businesses can have any kind of plan. Just some statistics for you: that small businesses, which we're talking about today, account for 99% of all the businesses that are out there, and they employ a significant amount of the workforce. I think it's about 50%, and a lot of those companies don't have any kind of qualified plan in place. So when I talk about qualified plan, I'm talking about 401k plans, profit sharing plans, defined benefit plans, cash balance plans. A very small percentage of those businesses actually have a plan in place. In some instances, that's because they just don't know what a plan can do for them. They don't know how to do it. They don't know how to implement it. They don't know what it would look like. But also sometimes they're concerned about their liability. You know, if they adopt a plan, they have responsibilities as an employer, not only, you know, as a business owner and maybe on a moral basis, but ERISA and federal law and the Department of Labor assign responsibilities to them. They are a fiduciary for the plan and have responsibilities there. So in this course, we're going to talk about some of those responsibilities and how the government is involved and what that really means for business owners, and how we can help them get through those concerns to actually set up a plan to benefit themselves and their employees. So hopefully by the time we get to the end of this hour, you'll have a better understanding of the important role that small businesses play in helping the U.S. workforce save for retirement. You know, everybody needs to save for retirement, and in this country, we are woefully behind. Help you understand how a plan governance process can be put in place to help reduce that liability for that business owner, so they're more inclined to put in a plan and not put themselves at risk. Identify some plan design elements that may help them, again, with those goals and also to achieve their personal goals and their business goals. You know, what do they want that plan to accomplish for them? And we'll also talk about some of the current compliance issues. We've had a lot of legislative changes in the last few years, and we'll touch on some of those. So here's some more information about that small business market. We're talking about here with companies with fewer than 500 employees, but don't overlook, we do a lot of plans for companies that have 10 employees, 5 employees, 1 employee. They're all small businesses. As we said, it's 99.9% of the businesses in this country have fewer than 500 employees. There are 33.2 million of them in this country, so we all know them. They are everywhere. They employ almost half the workers that are out there. And whereas large companies, almost all large companies these days have a retirement plan, typically a 401k, but only 52% of small employers do. So it's almost half. And as we already said, there are a lot of reasons for that. But part of it is they don't know, right? I said, part of it is their concern about responsibilities and commitments, but also 40% of small business owners, only 40% have actually spoken with a financial advisor about retirement planning. So a lot of the time it's just that no one is having these conversations with them, and they need to be educated so they know what their options are. So why is plan governance important? It's an important issue from the government's point of view because they want to make sure that these plans are compliant. They're doing what they were designed to do, and they're benefiting the people they are designed to benefit, which is the employees. And from the employer point of view, to make sure they're complying. They're doing what they need to do so they don't get in trouble. Now, here's just a little quick snapshot. Lawsuits do come out of these plans for failures. The Department of Labor particularly protects employees, from being discriminated against. And there are other laws that protect them. And we have ERISA, which creates a whole body of law that plans have to follow and comply with. So here's just a few examples where the plans didn't go so well and there were lawsuits. And you can see the most frequent failures are operational failures. Failure to operate the plan properly, failure to update their plan document, breaches of fiduciary responsibility. Now, there are several fiduciaries in every qualified plan. The business owner is one of them. They are a fiduciary. The plan trustees are fiduciaries. People handling the investments are, in certain definitions, are fiduciaries. And fiduciaries are personally liable under those duties. And so that is a very high risk. And you can see here where some issues have come up about fiduciary responsibility and that they have certain duties to uphold. So you want to make sure you don't want to run afoul of those rules. And so having some kind of plan in place can help protect that, all those fiduciaries, the business owner, trustees, usually it's the same person, anybody else involved, by first, understanding what their role is and what are they responsible for. Being aware of all the requirements, that the plan has to meet to stay in compliance with ERISA requirements, such as non-discrimination. Have some procedures in place to meet those fiduciary responsibilities. More and more over the years, we've seen regulations coming out that really are focused and looking at having a process in place to make sure that things are being done correctly, not just letting things run and then you don't know what might happen. And having thorough documentation of that process and procedures that the responsible parties of the policy of the plan can follow to make sure they stay in compliance. So a fiduciary is defined as any person or entity that is either named in the plan document as a fiduciary, such as the business owner, has discretionary authority over the management of a retirement plan or its assets, usually that's the plan trustee, or offers investment advice with respect to plan assets for a fee. And that was defined in Department of Labor regulations, which is an ongoing process, by the way. They are continuing to revise those regulations. So what are the responsibilities? So anybody who's a fiduciary for the plan basically must work kind of with these 4 areas in mind. They must work, and that plan must be for the exclusive benefit of the plan participants. If you're a fiduciary and you start operating that plan to benefit yourself personally at the expense of those participants, then you are not meeting that requirement. Prudent expert rule, you are expected to behave in a way and act held to the standards of someone who's an experienced professional would do. Pleading ignorance is not an excuse. Plan document rule, you must follow the plan document terms. That's why there is a plan document. It defines the terms and you have to comply with the rules of ERISA. And then diversification, this is on investments. The fiduciary must offer a wide range of investment options to help participants meet their investment needs. This is when you have participant directed accounts, as in a 401k. This would not be a rule that applies, for example, in a defined benefit plan where the employer is solely responsible for the investments. So If you are a fiduciary, you're prohibited from doing certain things, and there are written prohibited transaction exemptions that sometimes come into play under these more general rules that will say, generally you can't do this, but in this specific circumstance, it's okay. But generally, self-dealing is prohibited. So if the directive for making a transaction is to benefit someone over the participants, then that would be prohibited. That would be self-dealing. That would include sales and exchanges or leasing of property in the plan, lending money. Plans are not permitted to take on debt. Lending money and extension of credit could certainly run afoul of the prohibited transaction rules. Furnishing goods, services, and facilities. Well, to whom and who's being paid? Transfer or use of plan assets. Certainly, you can never transfer plan assets for your personal use. And then anything that comes under the self-dealing, using the plan assets for your own interest. Respect to plan transaction, acting on behalf of a party's interests were adverse to the plan. Again, working again the interest of the plan participants. And receiving any consideration for your own personal account from a party dealing with the plan. That would kind of be like bribing someone in a way, and that is certainly not permitted. Now, most of the time, these things are not happening, but they do happen from time to time, and we do see losses, just as we just saw a couple of examples. So what happens when a fiduciary fails to comply with those rules? Well, as a fiduciary, you can be held personally liable. That means worst case scenario, if someone came after someone for a fiduciary breach, let's say they're the trustee of the plan, and there was a serious fiduciary breach, they can read, the person who's going after them or the plan or the entity, whatever it is, can reach right through that plan to that person's personal assets. So they are personally liable. So what if they're found guilty? They'll be personally liable to make good on whatever losses the plan incurred, and also any profits that would have resulted from that breach. And there could be civil penalties and fines as well. And of course, they're likely to be removed as the fiduciary. So nobody wants to be in that position. I mean, I have conversations with business owners frequently where, first of all, they don't realize they're a fiduciary to the plan. And when they learn they are, they get a little nervous about that. So you can put practices in place to protect yourself as a fiduciary. And so this is where we talk about an effective plan of governance. You need a plan to monitor the functions of the plan, where the money moves in the plan, those kinds of transactions that could run afoul, if not watched, of the fiduciary rules. By having a governance strategy in place, you can certainly help protect everyone involved. Because a process would have checks and balances. So have a governance plan that discusses and defines how to select and monitor plan service providers. Overseeing plan investments. For example, if you are offering funds in your 401k and you have a terrible performing fund and it's over and over and over terrible, you should have a governance strategy that's a way for you to evaluate that performance of the fund and take action to correct it, rather than just not addressing it, those kind of things. Operate the plan according to the governing documents. Make sure you're complying with what the law says. Keep documents up to date for law changes. We have changes, legislative changes all the time in the qualified plan world, and the plan has to keep up with those. Ensure fulfillment of reporting and disclosure requirements. Employees and plan participants need to be notified of several things. Certainly when changes are made, they need to have access and know what their money is worth and what's happening with it in the plan. Avoid and or mitigate conflicts of interest. Sometimes the conflicts of interest are not so obvious. Sometimes they happen accidentally. So having a plan governance strategy can help catch those before they really turn into a problem. Build and maintain a document plan of governance process. It's good to have a written plan. It's detailed, that everybody knows to follow, and ensure that the governance team is effective, follows that plan, knows that plan, and has appropriate, educational opportunities to keep current. So basically it's just putting in a monitoring plan, defining criteria, and so that the plan knows what it's supposed to do, and those governing the plan and working on the plan know what action they should take. So we'll pause here for a polling question.
The poll is now open. The poll is now closed. The correct answer was B.
Okay, thank you. All right, so let's move on to ERISA 404C compliance, and what does that mean, and what is that all about? Now, 404C compliance has been around now for a number of years, and what it addresses, it provides a mechanism to shift investment responsibility to participants. When we have participant direction of the investments in their accounts, originally, now we're going back probably more than 10 years here, 20 years. There were a lot of issues, right? 401ks became active in 1981. Over the years, a lot of questions arose. Who's responsible for choosing the investments, and who's responsible for making sure the investments that are offered in the plan are the right ones? And what if they're not, or what if something goes wrong? Who's responsible? So 404C was provided to provide some parameters for that, and these helped to protect the fiduciaries of the plan, because now they weren't just guessing and running blind. Here's a set of rules that if they follow, they'll be protected and they'll have less fiduciary exposure. And so the basic requirements that there are a lot of specifics in the rules, but the basic requirements are that participants and beneficiaries will be allowed to exercise investment control over their individual accounts, something we're very, very accustomed to now as the norm. Choose from a broad range of diversified investments. So it does no good to offer 15 investment choices, but they're all the same. We have to have a diversification in investments for people to choose from, and receive investment information that's sufficient to enable them to make informed investment choices as to where they want to put their money in those investments. So if you're looking at an existing plan, you want to look and see, well, are you 404C compliant? So here are some things to look at. Does the plan document state that the plan intends to comply with 404C? Do the participants have the ability to control their assets? Certainly, if they do, then you want to consider whether you're compliant with 404C. Has the plan provided the participant with all the required information so that they can make their appropriate choices? That means not only the performance of the funds, but fee disclosures. If requested by the participant, does the plan provide the information that must be available? You have to be responsive. Employers have to be responsive when a participant requests information. They're entitled to that information. Does the plan provide the necessary participant information in a timely manner? Are participant investment instructions executed on a timely basis? Now, we're very, very accustomed these days to daily evaluation, where employees can go online and move their money around. So that's certainly, assuming it's executed within that business day or the next business day, as securities can be, that would be compliant. But not all 401k plans are on a platform like that. Sometimes there is manual intervention that's required, and is that timely? Do participants have the ability to change their investments as often as the volatility of the investments may require? Has to be at least quarterly, should be at least quarterly at a bare minimum. And does the plan offer that broad range of investment alternatives? These are some straightforward kind of questions to ask that plan, to take a look at that plan and see where it stands on all of these issues. All right, so that's 404C, talks about the investment selections. So now let's talk about an automatic contribution arrangement. So what about when an employee enters the plan and they don't choose an investment option? If they're deferring, where does that money go? This becomes an increasing issue if you have automatic deferrals in your plan, where that employee is automatically deferring. So they didn't even make a deferral election, they're just automatically deferring. Well, where do we put the money? Where do we put the money? Hence, rules were put out to control that, called qualified automatic contribution arrangement, referred to in the industry affectionately as QACA. So what are the benefits if you put this provision in your plan? Ideally, the intent here is to increase retirement plan participation by taking some of the mystery and the risk out of where that money's going to go. If we have a plan that's performing well, we have good participation from the employees, it usually will enable the business owners to put in more. If we include the provisions of QACA, the plan will automatically pass some of the non-discrimination tests. It will have automatic participation for employees. And Secure Act, we had Secure Act 2, 1 and 2. And this is a change with Secure Act 2.0. 1.0 addressed some of the auto enrollments, but now with Secure 2.0, for plan years starting in 2025 and later, all new 401k plans must have auto enrollment. Right, so auto enrollment means as soon as you're eligible to enter the plan, you are automatically deferring. So unlike the traditional 401k where you enter the plan and you elect whether you want to defer or not, now you will automatically be deferring and you will have to opt out instead of opting in. You can always opt out, it's not 401k prison, but the default will be that you're opting in. So what are these requirements if you're going to do this QACA arrangement, which is a safe harbor, so get you out of some of those discrimination tests? Well, the initial automatic deferral must start at least 3%. It can be anywhere between 3 and 10%, but it can't be lower than 3. That's year 1. Second year will automatically go up 1%. So now we have at least 4%. We go up another percent the next year to 5%. And then the fourth and subsequent years, it must start at least 6% and can be as high as 15%. There is a required employer contribution here that can either be a match or a flat percentage. If it's a match, it's dollar for dollar, up to 1% of compensation, and then 50 cents on the dollar for deferrals between 1 and 6% of compensation. If the employer chooses not to do a match, they can just put in a flat 3% for everybody. There is vesting. Salary deferrals are always immediately vested. The employer contributions must be 100% vested by 2 years of service. Participants have to be notified, of course. Annual notice to each eligible employee must be sent out explaining the terms that they're under and what the plan is providing. So let's have polling question number 2.
The second polling question is open.
Okay. Oh, we're still open.
The polling question will remain about 10 more seconds. The poll is now closed. The correct answer was A.
All right, it did increase it to 15%. The polling question got a little ahead of the slides here because that is in the slides. It was at 10% and now it's 15. All right, so now along these lines, again, maybe you want to consider kind of a participant patient and testing audit of your existing plan, of any existing plans, and see where your plan really stands. Is it doing what you want to do? Is the plan design itself preventing maximum contributions? If you haven't done a safe harbor kind of arrangement, whether it be a QACA or a traditional safe harbor 401k, those who are highly compensated employees may not be able to put in the maximum, and maybe they would like to. Consequently, maybe they've put in too much, and now we have to keep doing refunds to them because the plan is failing. These are things that can happen if you have not done a safe harbor. Also, this is one of the things that's triggering automatic enrollment, because we know if we don't have automatic enrollment, the overall participation will be lower. I believe the statistics are in typically, industry-wide. If you have standard enrollment where employees have to elect in, you'll get an average participation rate across the country of about 50%. If we have auto enrollment, that number goes to over 80%. The more participants deferring and the more they're deferring, the better it is for the highly compensated to put in what they want to be put in. Do you want to increase plan participation levels? Well, auto enrollment will absolutely do that. And are you concerned employees who are eligible for the plan don't participate and consequently won't have sufficient retirement savings? Remember that in the bigger picture here, the idea here is to help people put money away for retirement. We have a terrible retirement crisis in this country. People do not save enough for retirement, and that's all the way up and down the economic scale. And so this has been a high profile kind of discussion piece at the government level, at the federal level. How can we encourage and help people to save more for retirement? That's what auto enrollment can do. All right, so now let's talk about qualified default investment alternatives. These are called QDIAs. We don't have a shortened pronunciation for that. Again, this is, if that employee comes in and doesn't make it, now they're going to be auto enrolled, where's the money going to go? And here are some qualified rules that will protect the employer about where that money will go. And if they follow these rules, then the employer is not liable for the investment elections made by the participants. So it protects them from that liability. We still have to meet the 404C requirements, including allowing participants and beneficiaries to, exercise that investment control, have that broad range of investments to choose from, and receive the appropriate, educational information. Prior to the Pension Protection Act of 2006, we didn't have 404C. That's how long it's been around. So I said it's been a long time. And there was no protection for the employer. So now we have that protection with the QDIA. And so this makes it easier and safer for employers to have these 401k plans. So what is a QDIA? So some things that you have to permit by investment type: specialized funds. There are limitations. You can have multiple age-based target date funds. Are now very, very common. Variations thereof, but target date funds in plans. A single fund suitable for the average risk tolerance of participants based upon the demographics. For example, a balanced fund would be an example of that. A managed account. We can offer managed accounts in these plans based upon age and target retirement date or life expectancy. And then we have some short-term grandfathered solution like a capital preservation fund. Limited use, only available for the first 120 days. And then it must be redirected somewhere else. It couldn't stay in that fund. If it went into the top 3 up there, it could stay in there. But if it went into this capital preservation fund when they auto-enrolled, or the stable value fund here, it can't stay there. Now that grandfathered stable value fund is kind of an old provision. The capital preservation would be more current, 120 days, and then it's got to move out of there. It's a very short-term solution. So when you're looking at a plan and you're trying to evaluate where they stand relative to this, so number one, does the plan offer default investment? Does it, whether it has auto enrollment or not? Have you put a default investment in the plan? I think it's probably a good idea to have one, because you need to know what to do if a participant fails to make an investment election. Now, ultimately, we want them to make that investment election, but what happens if they're slow in doing it? Do you want to ensure you have a ERISA 404C fiduciary protection for the default investment? I would say yes. Is your plan's default investment option a QDIA? Does it meet those requirements of the QDIA, or have you somehow missed one or more of those requirements, so you come under that protection? Have you followed a prudent process for the selection of the plan's QDIA? Again, there's always needs to be a process to evaluate those offerings and make sure that they continue to be appropriate. Have you considered the DOL's tips for selecting target date funds? There's some information available there. Have you documented the selection process in your plan's investment policy statement? It's a good idea for every plan to have a policy investment statement. that serves as the guidance and the overriding control for how investments are done in the plan. So there's a process to, again, to protect the fiduciaries. Have you provided the required participant disclosures, which of course you have to give the employees to meet the QDIA requirements? Custom target date funds. Now these have become kind of increasingly popular, and that's okay. The DOL encourages consideration of some of these. Plan fiduciaries have control over key fund elements. Here they'll be a little more active, involved in the underlying funds, the asset allocation, and the glide path. Plan fiduciary is allowed to select the best fund provider and manager for each asset class. So you may have, if you have all your funds from the same fund provider, the odds are they're not all going to be best in class. Maybe some are and some aren't. Well, going down this path with the more custom treatment, so you can have a mix of funds, some from this provider, some from another provider, and you can change them and mix them up as you go. Now, some of the platform providers provide this service because they're monitoring the funds all the time. And incorporating already vetting existing plan investments makes it easier for plan fiduciaries to understand and communicate that to the employees. You always want to keep how we can communicate this to the employees in mind. Maybe we don't want to change everything all at once. So let's talk about what we have to tell the employees. We have to provide fee disclosure, right? If I'm choosing an investment as a plan participant, I ought to know what that is costing. So there's, requirements. Here's 3 different regulations from the DOL about providing fee disclosure. It happens at 3 different levels. So the first one is the service provider itself has to give information to the plan sponsor, right? They need to know what those what the fees are in that offering, and that would apply whether the plan is a defined benefit or a defined contribution, such as a 401k. There have to be guidelines, that say you have to disclose direct and indirect compensation of $1,000 or more. And if they fail to comply, then you can see here there could be corrections required plus a 15% penalty of the amount involved per year until it's corrected. So that's at the employer level. Now the plan sponsor has to disclose to participants, right? Because now we're going down a step. We have to disclose to participants and beneficiaries what those fees are. We have to disclose certain plan and investment related information, such as fees of the funds. And if there's a failure, then to disclose certain plan information, there would certainly be repercussions for that. And then we have, lastly, the filings, right? We have to file a Form 5500 for the plan. So the plan sponsor of that plan has to file a 5500. Now there are different 5500s. There's a 5500 EZ if you only have one participant. Then there's a standard, there are a couple other versions of the 5500 depending on whether you have more than 100 or less than 100 employees. Plans with 100 or more participants, they have to give additional information to the IRS and the DOL. They report direct and indirect compensation from the plan of $5,000 or more that is paid to the service provider. And if they fail to do that, you can see there could be some pretty substantial penalties of $250 a day with a maximum penalty of $150,000. The DOL is a $2,400 penalty per day with no maximum. So, these are rules, governing rules. You must comply with these rules or the penalties can be pretty significant. All right, so here we are again. So now we want to audit our existing 401k plan to see where we stand relative to these disclosures. Do you compile adequate information that allows you to evaluate whether the plan fees and services are reasonable? This is something in 401k audits that the IRS and the DOL do look at, that those fees should be reasonable. If you haven't repriced and reevaluated that plan over a number of years, you could be failing that. Do you satisfy the 5500 Schedule C reporting requirements if you have those more than 100 employees? Do you have service providers, have your service providers discuss with you the expanded disclosures they must provide, and are they providing them? Do you know which service providers are acting as fiduciaries? Certainly a question depending on the provider. Some offer those fiduciary services, some do not. You want to look at your contracts with those providers. Do you understand the information plan service providers have supplied? And is it complete? Is it accurate? Have you evaluated your compliance with the expanded participant disclosure requirements? There are new and expanded disclosure requirements to employees that you want to make sure you're meeting. Hopefully that provider is supplying those, but you certainly want to check. All right, so we've talked about kind of all these overriding rules that have to do with fiduciary responsibility in operation of the plan, in expenses of the plan, in ERISA compliance, in fees, in investment choices. So let's talk a little bit about plan design. So what is plan design about? A plan design is all about getting to the business owner's objectives. Different businesses have different objectives in setting up a plan. And so this comes down to fact finding, finding what that owner wants to accomplish, and then kind of going to the design table. And we have all these different types of plans available to us, and figuring out which is the best fit to achieve their personal goals and their goals for the business. Plans, designs, the tools we have available range everything from a one-person individual K, simple plans, set plans, 401k plans, all the way up to defined benefit plans, cash balance plans. There's a wide range of plans to choose from. They all have their features that are different. They have different contribution amounts that can be made. They favor different types of people. So all those things come into play. That's where your pension professional comes into play in designing the plan and trying to meet the goals of that business owner. Obviously, in any plan that's designed, it has to meet the cash flow needs of that employer. There's no point in designing a plan they can't afford. The employee demographics will always affect the design. Some of these plan types, the contributions will be controlled by pay only. Some will be controlled by age and pay. And so the demographics of that company become very important. And what does the owner want to choose? Do they want to favor themselves? Do they want to favor employee B? Do they want to do a generous contribution for all their employees? Is this an employee retention tool? What is it they really, really want to accomplish with this plan? And then we take those objectives and we go to the different plans that are available to us, and we start looking at options and start running designs to see what might work best for that business owner. So, if they have a current plan, we want to look at some features that may be affecting them there. So, is the owner unable to maximize their contributions? Let's say they have a 401k in place, and that owner cannot make his maximum salary deferral, which right now, if you're 50 or older, would be $30,000, $22,500 if you're under age 50. Well, if they have not put in some kind of a safe harbor design option, they probably cannot do that because they're failing the ADP test. Well, would they like to be able to accomplish that? We could change the plan design and enable them to do that. Same thing with testing failures. Is your plan failing either because those at the top have over-contributed, or we're not covering the right people, we're not covering enough people, we've left people out of the plan, whatever that might be. There are ways to address that and cure that in a plan as well. What about increasing participation? If your participation in your 401k is low, how do we get it up? How do we get more employees to participate in the plan? Participants are going to look for enticements. What is this plan going to do for me? Why should I be in this plan? And we want to make sure that it's attractive. And of course, auto enrollment would also help with that. And we also, of course, always want to reduce fiduciary liability by having the right design, the right features that's a good fit for that business and their employees. So here's our array of plans. There's actually more sub kinds under here, but this is a good snapshot. So SEPs, lots of companies, small businesses have SEPs. Any business can set up a SEP. Any business can have a qualified plan. It doesn't matter whether you're incorporated, unincorporated, sole proprietor, partnership, LLC, sub S, C corporation. It doesn't matter. Any business can have a plan. A SEP is fully employer contribution. There are no employee salary deferrals here. The maximum contribution is 25% of the total payroll of everybody who's in the plan. And in a SEP, everybody gets the same percentage. So if we're contributing 25% for the owner, everybody will get 25% of pay. That money goes directly into IRAs, so it's fully vested. We can't sway the money at all, just strictly 25%. The maximum someone could get this year in a SEP plan is $66,000. Simple, easy to set up. You use a government form, open the IRAs, and you're pretty much done. And that contribution is entirely deductible for the business. Simple IRA is kind of a simplified look-alike 401k. So you have to have 100 or fewer employees to have this plan. Again, you could be any business entity, but you have to have less than 100 employees. Here we have salary deferrals in addition to an employer contribution. The salary deferrals here are lower than a 401k. They can only be up to $19,000. And then we have a required employer match here in a simple plan, and in total, no one could get more than $38,000. So simplified version of a 401k, but the amounts are lower. But the employer saves on administration expense because they don't need a third-party administrator for either a simple or a SEP. But if they want to put in more money and they want to get more control over how the plan works and how it's designed, we have to step into the world of the true qualified plans. So these are under a different section of the Internal Revenue Code, 401A, and these are true qualified plans. So here the money is not going into IRAs, it is going into a trust that is created by the plan and held on behalf of the participants. So first we have 401k. So we could do 401k salary deferral only, or maybe just deferral, maybe there's a match. And in the middle column here, you can see any business can set this up, except not a governmental entity. They're the only ones who can't have a 401k. The salary deferrals this year are limited to $22,500. Plus, if you're 50 or older, you can do another $7,500. So that's total deferrals of $30,000. And then on top of that, we can have an employer contribution of 25% of pay, which does not have to be spread evenly to all participants. We can use a variety of profit sharing allocation methods to spread that around. Altogether, between the salary deferral and the employer contribution, it's the same limit of $66,000 per person, except for those age 50 and older. That $7,500 additional catch-up is on top of that. So they could get the $66,000 plus the additional $7,500. And so you can see here that would take them up to $73,500 under that profit sharing column if we really wanted to maximize somebody. And then we have defined benefit plans. Now there are several different types of defined benefit plans. They'll have different design features, but they all have the same limits. Here there's no contribution limit, no $66,000 limit. There is a benefit limit here instead of a contribution limit, because 401k plans are defined contribution plans. So they define the contribution, defined benefit plans define the benefit. And so the limit is on the benefit. Those limits are quite large. In a defined benefit right now, we could fund to a maximum benefit of a lifetime annuity of $245,000 a year. At retirement age, that will translate into a lump sum of about $3.5 million. How much the contribution is dependent on how old the person is and how many years we have to build that account. So we can see contributions here that far exceed $66,000 for a person. Any business can have these, and it's fully funded by the employer. There are no salary deferrals here like a 401k. All right, so let's have our next polling question.
The polling question is now open. The poll will remain open for another 10 to 20 seconds. The poll is now closed. The correct answer was
Okay, thank you. All right, so where do we start? So if we're talking to a business owner, what plan is right for them? How do we choose from this entire world of offerings to know what's right for them? Well, the first place to start is, how much do you want to contribute to this plan? How much do you want to contribute, whether that's controlled by current budget, which is always going to come into play. How much cash flow do they have available to work from? Sometimes it's driven by how much of a deduction they want. Sometimes it's a conversation, I've decided I want to retire, in 5 years, 10 years, whatever that might be. I need to accumulate as much money as I can within their available cash flow to do that. So it kind of starts first with, how much do you want to contribute? And you can see here, if we're in this first low range, 6,000, 7,500, we'll talk about a traditional or Roth IRA. No reason to go above the thresholds they can do in an IRA. That way it's easy, it's simple, it's completely in their control, completely flexible, and so that would make sense for them. Now, if they want to get higher than an IRA, but they're satisfied with either 23,000 or 25,600 if they also get the catch-up, a simple plan might be a good alternative for them. For small employers, this can be an easy option to do. It's easy to set up. Again, the money goes into IRA accounts, so the employees will be fully vested. There is a required employer contribution here. Here they're talking about a 2% non-elective. So everybody in that plan, and you have to let employees in, would get a 2% contribution from that employer, whether or not they deferred if you're using that design. But it's a simple, relatively inexpensive, and that 2% is deductible to the company. So that's a nice, easy route to go. But if they want to do more, now we want to step into a true 401k plan. But let's say that employer wants to be able to make salary deferrals and wants their employees to have the benefit of making those salary deferrals in greater amounts, but they don't want to contribute, right? If we do a simple, the employer has to contribute. But we could do a 401k plan that's strictly salary deferrals. So every employee who meets the eligibility requirements has the opportunity to save money for their retirement. Keep in mind that might be pre-tax or Roth, as the plan might provide. And so the employer is not putting in any contribution. They're just making this available to their employees. They do still have the expense of operating the plan, though, because they do need a plan administrator here, and most likely it will be on an investment platform. So they will have some operational expense, even though they're not making an employer contribution. If they wanted to go a little bit higher, but not a match, they could go back to doing a simple, but instead of doing the 2% non-elective contribution, they can do a 3% match. So now they're going to match anybody dollar for dollar for the first 3% of pay they defer. Now you don't have any administration expense because, again, the money's going into IRAs. Instead, they're giving that money to the employees in the form of a match. And now, for someone who deferred the maximum allowed and picked up that full match, the numbers are a little bit higher. Now we're up to 31,000 or 38,000 for someone who gets the additional catch-up because they're 50 or older. Now, maybe that's not enough. They say, no, I want to do even more. All right, let's go to a SEP. Now, depending on their compensation, right, if they're only making $100,000 and our SEP contribution is 25%, they're only going to get $25,000. They'd be better off in a simple. They could probably do money there. But if their salary is higher, the 25% contribution might take them over and above what they could do in a simple and could get them up as high as $66,000. So if they're in that situation, then a SEP could be a good answer for them. Again, no administration, it's going into IRAs, but they will have to contribute for anybody who's eligible. Anybody who worked 3 out of the last 5 years is, even if they're part-time, is going to be eligible and will also receive that contribution. Now, let's say they have more employees. set kind of gets pretty expensive if I have to make a 25% contribution for all my employees. So now maybe I want to go to an actual profit sharing plan. Now I have the maximum salary deferral potential, the 22,500 plus the catch up. And I can make a match maybe. I can make a profit sharing contribution depending on how I want to design that plan. And now I can potentially get up to 66,000 or 73,500 if I also get that catch up. And I can do that without necessarily having to give the same equivalent percentages to my employees. I can swing this plan to be more in favor of myself and some other people that I might choose. So I get more control here. The employer contribution I put in can be on a vesting schedule, so it encourages employee retention, unlike a SEP or simple where the employee could walk away any day with that money. So you get a lot of flexibility here. You get more design control, and you get that vesting schedule. But for that, you will have to have a plan administrator, and you'll pick up that platform probably, so you'll have additional operational expenses. And then if someone still is not satisfied there, now we go into the defined benefit world, where we can have much, much larger contributions depending on the plan design we use. We don't have to give everybody the same amounts, and that really becomes a design discussion. But we can really increase the contribution opportunity here. This could be layered on top of a 401k plan or instead of. Either way, they could do one or both plans if they wanted to. It will have higher administration. It does not have a platform here and a defined benefit, but you will have administrative costs. And you need an enrolled actuary here, so they'll be a little bit higher. So how much higher could we go? Well, here's just some sample numbers. If we had by age, let's say we had a 35-year-old and they deferred the maximum 22,500, and we gave them the maximum profit sharing we could, which would be another 43,500. We could layer on top of that a cash balance plan, which is a type of defined benefit plan, and their contribution addition there would be 83,000. So we've gotten them up to 149,000. Now, these defined benefit plans will favor anybody who's older. So let's say instead of being 35, let's say they're 55. Well, now they can also do the additional 7,500 catch up as a salary deferral. So they're up to $30,000 there, same profit sharing, but now their cash balance contribution is 228,000 for a total of 301,000. And you can see if they were 65, now we're all the way up to a 307,000. We've got them a total contribution of $380,000. So we've come a long ways from that SEP or simple, where they could put in those much lower amounts, all the way up to here to $380,000, all by plan design. What meets their needs, what meets their objectives. It's all possible. It's a question of what's the right fit for that employer. So I've said there have been a lot of legislative changes recently, so let's just spend the last few minutes kind of talking about what's been going on in Washington. And it's been a lot. So first of all, they tend to look at, they always look at, and the IRS is looking at, where are these plans failing? How do we try to fix that? And what do we do going forward? Here are the 10 most common compliance issues that come to the surface for employers where there are failures. How a company handles its fuller plan, partial plan termination. They're not always so cleanly done, and a lot of employers don't realize that they sell or buy, a division if it moves from company to company. By eliminating a significant percentage of your workforce, you may create what's called an involuntary plan termination. And then there are things that must be done. Sometimes that doesn't happen properly because the employer is unaware of that. Same thing with buying companies. Mergers and acquisitions have to be taken into account and can change a plan. How the plan performs non-discrimination tests. Are they doing it properly? The definition of compensation. It seems like such a simple thing, but we see this wrong all the time. It's not quite as black and white as it would seem. Failing to timely amend plan documents when changes are required. And full documents have to be restated every 5 years, and in between, if rules are changed, frequently amendments are required, and those need to be adopted to stay in compliance. Properly applying vesting schedules. for people when they leave. And then handling distributions and loans, there are rules. They have to be followed to make sure those are done and tracked correctly. Plan fees and how the assets of the plan are invested. This comes back to the fiduciary liability. Are they the appropriate investments? Are they proper? Are they being properly handled and evaluated? Excess salary deferrals and employer contributions. Oops, we contributed too much. We have to fix that. And then, of course, lack of internal controls over all of this to make sure that these failures are not happening, and making sure the correct information is used for all purposes, but including being filed on that Form 5500. Some other things that really happen a lot is we see a lot of late deposits of deferrals. When the employee defers their money, there are very strict requirements about when that actually has to be deposited in the accounts very quickly. A lot of failures there. Excessive service provider fees. I see these most frequently when a plan hired a service provider when the plan was small. Now it's grown and they could get cheaper fees, but they haven't repriced it. Imprudent or improper investments, bankruptcies, obviously that's a problem for everybody involved. Just abandoned pension plans, they stop paying attention, they stop taking care of it, and then they obviously are going to fall out of compliance. Having assets in a plan that are hard to value. Real estate is an obvious one. If there's real estate in a plan, which you're allowed to have, but it has to be valued every year. And then, of course, there's all the exposure for fiduciaries who don't really fully understand what it is they need to be doing both to protect the plan and to protect themselves. So lastly, just a word on Secure Act 2.0. The big change that's catching everybody's attention is with Secure Act 1.0, the rule was changed that we have to bring part-time employees into a 401k plan after 3 years. So what are called long-term part-time employees. They have to come in for salary deferrals only. The employer does not have to make contributions, but they have to be brought into the plan. Well, Secure Act 2.0 changed that to 2 years. So now if you have part-time employees with you for 2 years, they will have to come into that 401k plan. They also, just did some more detail around those rules, but also, not only 401k plans, but 403b plans. They did a nice thing. There's a tax savers credit for new plans that employers can get this tax credit to help offset expenses when they set up the plan. That's a nice thing. They expanded that, so that's a good thing for employers. They gave some more lenient rules for military spouses to enter plans and for a credit to be given to the employer because they're bringing those people into the plan. So that's also a beneficial thing. But plans have to be aware of this in case they have military related personnel, participants in their plan. And lastly, this is an interesting one. It's now permissible to give an employee an incentive or a reward for participating in the plan. You can never do that before. So now you can't give them just anything, but you can give them the small benefits like gift cards, I don't know, a Starbucks card, things like that, just to, kind of entice people to get them to sign up and go into the plan. We have new starter 401k plans or 403b plans. These have much lower contribution limits. They are simpler, they are easy. It's an automatic enrollment again. Haven't seen a lot of traction around this. Discussion-wise, they're not available yet. So we'll see what happens with these. Sole proprietors can now make their salary deferrals up until they file their tax return. This was always just a glitch in the law because they don't know their income by December 31, and yet we had a December 31 requirement for salary deferral. So this was a nice give to those sole proprietors. There's some other big changes. We can now have Roth contributions and simple IRAs. SEP contributions can also be treated as Roth starting next year. Defined contribution plans, 401k plans, can give the participants the option of receiving any matching contributions as Roth contributions. That started this year. So that's significant, especially for younger employees. And lastly, which is not on the slide, for people deferring into a 401k, this is a big bone of contention, who make more than $145,000 and then make catch-up contributions, their catch-up will have to be as Roth. I'll leave you with that thought, and we'll go to our last polling question.
The poll will remain open for about 10 more seconds. Poll is now closed. The correct answer was D.
Thank you. So just a quick summary here. You know, small businesses employ so many of U.S. workers, and we need to help people save for retirement. The IRS, Congress, and DOL have actually been implementing these rules, such as the auto enrollment, to actually help people to do that. But as plan sponsors, we all have to be aware of those changes. We have to be aware of the fiduciary responsibilities involved and protect everybody by putting these governance processes in place, so we make sure that we're staying on track. That helps everybody. That benefits the plan sponsor, benefits the trustees, and benefits the participants. And then, of course, we always want to make sure that we have the right plan design for that employer. So with that, that wraps up my part of the presentation, and I think we're right on time, and we can wrap up.
Thank you, Mary, and thank you everybody for joining us today. As a reminder, if we didn't get to your questions, we will follow up with you after today's presentation. And as a reminder, we will also be sending you survey questions at the end of this. They will pop up on your screen. And thank you again for joining.